Navigating market volatility is a crucial aspect of successful trading. Volatility refers to the degree of variation in a financial instrument's price over time. It can create both opportunities and risks for traders. Navigating market volatility. Strategies for confident trading likely refers to a guide or resource aimed at helping traders manage and capitalize on market fluctuations. Here are some strategies that might be covered in such a guide. Risk management. Maintaining proper risk management is paramount during volatile markets. Traders should set stop-loss orders to limit potential losses and avoid overexposing themselves to a single trade. Diversification. A diversified portfolio across various asset classes can help mitigate risk. This involves investing in different types of securities to reduce the impact of a decline in any one area. Hedging. Traders may use options or other derivative instruments to hedge their positions against potential losses. This involves taking offsetting positions to reduce risk. Technical analysis. Utilizing technical indicators and chart patterns can help traders identify potential entry and exit points. During volatile periods, these tools can offer insights into trends and potential reversals. Fundamental analysis. Examining the fundamental factors affecting an asset's value can provide a longer-term perspective. Understanding the underlying strengths of a company or asset can help in making informed decisions during volatile times. Adaptability. Traders need to remain adaptable and open to changing strategies as market conditions evolve. What works in stable markets might not be suitable during high volatility. Position sizing. Adjusting the size of trades based on market volatility is important. Smaller position sizes during high volatility can limit potential losses. Utilizing volatility. Volatile markets also offer opportunities for profit. Traders can consider strategies like day trading or swing trading to capture short-term price movements. Staying informed. Keeping up with financial news, economic indicators, and geopolitical events can help anticipate potential market moves and make more informed decisions. Emotional control. Emotional reactions can be amplified during volatile periods. Maintaining discipline and avoiding impulsive decisions is crucial. Backtesting. Testing strategies using historical data can help traders understand how their methods would have performed in past volatile conditions. Cash reserves. Maintaining some cash reserves can provide liquidity and allow traders to take advantage of opportunities that arise during market dips. Remember that each trader's risk tolerance, investment goals, and experience level are different. Therefore, any strategies outlined in the guide should be carefully considered and adapted to individual circumstances. It's also essential to be aware that even with strategies in place, there's no guarantee of success in trading, particularly in volatile markets.